Hi everybody, and welcome back to video number 2 in chapter 22. And when we left off, we were looking at determining the change in cash and net cash flow from operating activities, and we'd gone through the 2 steps shown on this slide. So, to arrive at net cash flow from operating activities, a company must determine revenues and expenses on a cash basis, not an accrual basis. It does this by eliminating the effects of income statement transactions that do not result in an increase or decrease in cash. And the way we do that is illustrated generally by this diagram. Here's our recognized revenues and our incurred expenses, which results in net income. And then we eliminate our non-cash revenues and non-cash expenses, and we get our net cash flow from operating activities. So the indirect method, which I think is the easiest, starts with net income and converts it to net cash flow from operating activities. In other words, the indirect method adjusts net income for items that affected reported net income but did not affect cash. So to compute net cash flow from operating activities, a company adds back non-cash charges in the income statement to net income and deducts non-cash credits. So let's see how we do that. Here is an analysis of accounts receivable. So an increase in accounts receivable under the indirect method. So accounts receivable increased by $36,000 from 0 to $36,000 during the year. You can see that easily from these balances. Now, when accounts receivable balance increases, cash receipts are lower than revenue earned under the accrual basis because we've debited accounts receivable and we've credited revenue, but that did not result in cash received. Okay, so here is our net income, and we make an adjustment to reconcile net income to net cash provided by operating activities. So an increase in accounts receivable is a decrease in cash. An increase in accounts payable is an increase in cash. Now, the way I remember this is that if I go to Nordstrom's and I buy myself a shirt for $100, let's say, if I do that, my cash goes down to pay for that shirt. But when I get that shirt home, my inventory of shirts goes up. So just like it's shown here for an increase in accounts receivable, an increase in any other current asset, such as inventory, would also result in a decrease in cash, just like my shirt example that I buy from Nordstrom's. Okay, so it's just the opposite for current liabilities. And in this case, as you see, an increase in accounts payable is a increase in cash. All right, so step 3 then, determine the net cash flows from investing and financing activities. Now, this is not done on an indirect method. This is done using the direct method. So after Evergreen has computed the net cash provided by operating activities, the next step is to determine whether any other changes in balance sheet accounts caused an increase or decrease in cash. For example, an examination of the remaining balance sheet accounts for Evergreen shows increases in both common stock and retained earnings. The common stock increase of $60,000 resulted from the issuance of common stock for cash. So if we issue common stock, it is reported in the statement of cash flows as a receipt of cash from a financing activity. Now, two items caused retained earnings to increase $20,000. Number one, we made net income of $34,000. That increased retained earnings when we did our closing entries and brought net income over to the balance sheet in retained earnings. Number two, however, we declared $14,000 of dividends not on the income statement, and that decreased retained earnings. The additional data indicates that the dividends were declared and paid. So that's going to be a decrease of cash. So if we analyze the retained earnings account, here's our net income, less the dividends we declared, give us our ending retained earnings balance of $20,000. So note that the company is going to report the dividend payment as a cash outflow in the financing activities section. And note also that if the dividend had only been declared in 2024 and not paid, it would not be included as a cash outflow. Okay, statement of cash flows then. We've got it all ready to go. Here we go with net income. We make our adjustments here for items to reconcile net income to net cash, and that gives us a net cash provided by operating activities of $3,000. We issued our common stock. We got $60,000 for that. We paid dividends. We paid $14,000 for that. So our cash flow from financing activities was $46,000. Okay. There were no investing activities associated with this particular statement of cash flows. So our net increase in cash would be the sum of this $3,000 plus this $46,000, total $49,000. So our cash at the beginning of the year was zero, and so our cash at the end of the year was $49,000. Okay. The $60,000 increase in common stock results in a financing activity of cash inflow. The payment of dividends is a financing activity. That's an outflow. The $49,000 increase in cash reported in the statement of cash flows will agree with the increase of $49,000 shown in the comparative balance sheets as the change in the cash account. Okay, now here's some comparative balance sheets now for 2025. Things have changed quite a little bit as Evergreen is becoming more sophisticated. Now we have several asset accounts and the changes associated there too, and more liabilities and equity items and the changes in those accounts as well. So now, if I look at my income statement for the year ended 2025, I now have substantial revenues of $492,000. I have operating expenses, but that excludes depreciation. Depreciation is a non-cash expense, so we want to know what that is, and it's $21,000. Okay, so my income from operations, income tax expense, and finally net income. The company declared and paid an $18,000 cash dividends. Bravo! The company obtained $150,000 cash through the issuance of long-term bonds. And also land, building, and equipment were acquired for cash. So, first step, determine the change in cash. And to prepare a statement of cash flow from the available information, the first step is to determine the change in cash. So as shown in illustration 22.10, the cash decreased $12,000. and that's $49,000 here. Subtract 37,000. Here's the $12,000 decrease in cash. So where did it go? Inquiring minds want to know. Okay, using the indirect method, we're going to adjust our net income of $134,000 prepared on an accrual basis to arrive at net cash flow from operating activities. The explanations for those adjustments to net income follow. Accounts receivable decreased. Accounts receivable decreased during the period because the cash receipts, that's cash basis revenue, are higher than the revenues reported on an accrual basis. So to convert net income to net cash, the decrease here of $10,000 must be added to net income. You'll remember in my shirt example, inventory went up, and that was a decrease in cash. But if inventory had gone down, or for that matter, accounts receivable have gone down, that's going to be a decrease in cash. So we also had an increase in prepaid expenses. That increase in expenses are lower than they were on a cash basis. And the reason is Evergreen has made cash payments in the current period, but expenses as charges to the income statement have been deferred to future periods. So to convert net income to net cash flow from operating activities, the company must deduct from net income the increase, again, an asset that's increasing. So we're going to subtract that as a use of cash of $6,000 in prepaid expenses. And prepaids are a current asset, as you would know. So any increase in a current asset is going to be a decrease in cash. Okay. Now, also, we have an increase in accounts payable. Like the increase in 2024, Evergreen must add the 2025 increase of $35,000 in accounts payable to net income to convert to net cash flow from operating activities. So an increase in accounts payable means that means we would add that the company incurred a greater amount of expense than the amount of cash it disbursed. Okay, then finally, depreciation expense. That's an easy one. That's an increase in accumulated depreciation. And we purchased some depreciable assets, and that was a use of cash, as shown in the investing section in the year of acquisition. So Evergreen's depreciation expense of $21,000, also represented by an increase in accumulated depreciation, is a non-cash charge. The company's going to add that back to net income to arrive at net cash flow from operating activities. The $21,000 is the sum of the $11,000 of depreciation on the building plus the $10,000 depreciation on equipment. Other periodic charges to expense do not require the use of cash, and those examples would be the amortization of intangible assets and depletion expense. Such charges are treated in the same manner as depreciation. Companies frequently list depreciation and similar non-cash charges as the first adjustments to net income in the statement of cash flows. Okay, so here we go. We have our net income. We've adjusted that by adding depreciation expense, adding the decrease in accounts receivable, adding the increase in prepaids, another current assets, and adding the increase in accounts payable. Total is $60,000. So the net cash provided by operating activities, $194,000. That looks like a good place to end this video. And when we return, we'll take a look at investing and financing activities. Until that time, bye for now.